Hello viewers, now I am explaining you the format of final accounts of sole trading concern. So previous video I have explained you in detail regarding the final accounts of a sole trading concern. So previous video I have explained you in detail the components of final accounts, trading, profit and loss account and balance sheet. What is the importance, how it is prepared. Now in this video I am explaining you the format. So if you have not watched the first video, please go to the first video, watch it completely, then only you can be able to explain this continuation, part 2 of final accounts. So I'm Hashim Ali Khan. I'm taking the topic financial accounting. In financial accounting already BRS I have completed, and also second topic final accounts of sole trading concern I have started. Now for new viewers, if you are first time watching my video, please I suggest you to go to the playlist of my channel, select the concerned subject. So many subjects videos I have uploaded, and watch the videos. Now first of all I'm explaining you about the format of trading account. So trading account of dash for the year ended dash. This should be the heading of the trading account. Now see the format. I have explained you trading account is prepared to find out the gross profit, and gross profit is the difference between sales and cost of goods sold. Cost of goods sold means opening stock plus purchases plus all direct expenses minus closing stock. That is cost of goods sold. So on one side, debit side, we take all expenses. Credit side, all we take incomes. It's a nominal account. So credit side, first item, by sales, minus sales return. If in the problem sales returns are given, subtract sales return from sales. Take the net sales in the outer column. By closing stock, outer column. So these two items are normally found in every problem. So trading account credit side, sales and closing stock. Debit side, first item you take opening stock, which will be given in the trial balance. Then we take the purchases. Inner column we should take purchases. If there are any purchase return, subtract purchase return, take the net purchase in the outer column. Now apart from that, some direct expenses may be given in the problem. It will not specify whether this item you should take in trading account or profit and loss account. You should know it. So in previous video I have explained you, direct expenses are those expenses which are incurred to bring the goods to its present condition and situation. So if you are a trader, buying the goods and selling the goods, so whatever expenditure you are incurring in bringing the goods to its present location and condition, those expenses are called direct expenses. Suppose if I am the trader, I am bringing the goods from one market to this particular market. So to bring the goods from that market to this market, I am incurring some expenditure. Expenditure like carriage inwards, freight, wages incurred to download the material, etc. So examples of expenses which may be debited to trading account are carriage inward. There are two types of carriages, carriage inward and carriage outward. If carriage inward is given, take it on debit side of trading account. If carriage outward is given, take it on the debit side of profit and loss account, where we should take profit and loss account debit side. So remember the difference. Carriage inward means the expenditure incurred to bring the material, to bring the goods to our stores. That is carriage inward. Here, carriage outward means the expenditure incurred in taking the finished goods to the showroom. It is selling expenditure. So that is an indirect expenditure that will be taken in P&L account. If nothing is mentioned in the problem, only carriage is given, assume it is carriage inward. If only carriage inward, outward, nothing is given, so you have to assume it is carriage inward and take it to the trading account. Next, freight duty. Then freight duty and clearing charges, direct wages, excise duty, octroi or customs duty, factory rent and insurance. So any expenditure relating to factory will be taken as direct expense, debit side. So factory rent, factory lighting, factory insurance, all these will be taken in trading account. Then motive power, coal, gas and water. These are few expenses which normally you come across in every problem of final accounts. So you have to remember these expenses which are debited to trading account. Again I repeat, carriage inward, freight duty and clearing charges, direct wages, excise duty, customs duty, octroi, then factory rent, insurance, factory lighting, etc. Then motive, power, coal, gas and water. These are few expenses you have to remember. First 4 items are compulsory. The 4 items are sales less returns and closing stock. These 2 items on the credit side and 2 items on debit side. Opening stock purchases. Opening stock purchases, sales, closing stock. These 4 items are compulsory must in every problem. Remaining these expenses, few expenses may be given, few expenses may not be given. 1 or 2 expenses are given. You have to remember these items. After taking all these items on debit side, now you have to see whether debit side is more or credit side is more. If credit total is more, suppose if the total of the credit side comes to 10 lakhs and the total of debit side from opening stock to coal, gas and water 8 lakh. So credit side 10 lakh, debit side 8 lakh you are getting. So 10 lakh minus 8 lakh, 2 lakh rupees is the balancing figure. 2 lakh rupees is the balancing figure. That is the gross profit carried down. C by D. Gross profit carried down, balancing figure. So we got the answer of trading account. We got a gross profit of 2 lakh rupees. How 2 lakh? Credit side 10 lakh, debit side 8 lakh. So 10 lakh minus 8 lakh, you'll get balancing figure 2 lakh. That's all. This is the format of trading account. So just if you watch with concentration, you can be able to understand while doing the problem, you don't find any difficulty. Now I'm coming to the format of profit and loss account. The format will be format of profit and loss account. Profit and loss account of dash, name of the businessman, name of the person will write down. Then for the year ending dash. So for the year ending, for which period we are preparing the profit and loss account. The profit and loss account again is a nominal account. Debit side all expenses, credit side all incomes. First of all, credit side, the first item is gross profit, which is brought down from trading account. In trading account, we got the gross profit balancing figure. This is carried down, carried over to where? To profit and loss account. The profit and loss account by gross profit brought down this amount. So this gross profit is coming from trading account. You got 2 lakh rupees here trading account, 2 lakh rupees gross profit. Same 2 lakh rupees you have to take it on the credit side. Then other indirect incomes. Other indirect incomes of the business. So examples of indirect incomes are rent received, dividend received, commission received, interest received, miscellaneous income. These are the examples I have taken. Don't think that every problem we will have all these things. If you watch with full concentration, it will be in your mind that these are the other incomes which should be taken on the credit side of profit and loss account. Right? Now debit side. Debit side all indirect expenses. Indirect expenses like office expenses, administration expenses, selling expenses, distribution expenses, then intangible expenses written off, non-cash expense like depreciation, provision for doubtful debts, all these things we will take it on the debit side. The example of expenses, I am giving you a few examples. Salaries. Remember, wages and salaries are different. Wages will be taken on the debit side of trading account. Salaries will be taken on the debit side of profit and loss account. Then what is the difference between wages and salaries? Wages normally are paid to workmen who are doing physical work. Like the workers working in the factory, doing some physical work. We pay wages to them. That will be treated as a direct expense. Salaries are paid to employees who are doing more mental work than physical work. They are the employees. They are white collar job employees. They are working in administration department, selling and distribution department. So these are called salaries. So if in the problem wages are given, take it on the debit side of trading account. Salaries are given, P&L account debit side. Sometimes wages and salaries or salaries and wages will be given. Then how to treat that one? What is the first word given? You have to see. If the first word is given salaries and wages, then you should take it on the debit side of profit and loss account. If in the problem wages and salaries are given, take it to the trading account debit side. So you see the first word, if it is given salaries, P&L account. If the first word is wages, take it on the debit side of trading account. That's it. Then we have rent, rates and taxes, lighting, printing and stationery, postage and telegram, telephone charges, legal expense, audit fees, general expense, advertisement, travelers' salaries, bad debts, provision for doubtful debts, depreciation, repairs and renewals, discount allowed, carriage outward, interest on loan, interest on capital. Remember, these are few examples I am giving. Don't think all these items will be there in every problem. In order to get an idea what are the different items that may be debited to P&L account, I have given the examples. By going through this, you can be able to remember while doing the problem. Immediately it will strike in your mind that this item will be taken on debit side of P&L account, this item will be taken on debit side of trading account. Now, the total. Now we take the total on the credit side. If the credit side total is, let it be 5 lakh. Credit side total will be 5 lakh rupees is the total on the credit side. Debit side, if you take the total up to interest on capital, from salaries up to interest on capital, you will find, suppose, example, 4 lakh rupees is the total. 5 lakh rupees credit side total, 4 lakh rupees debit side total. So 5 lakh minus 4 lakh, 1 lakh rupees is the balancing figure. That is the net profit balancing figure. This net profit will be transferred to capital account. It will be added to capital account in the balance sheet. Suppose if debit side is more and credit side is less. Suppose, example, if debit side is more and credit side is less, you will get net loss. Here on credit side, you should write on by net loss, balancing figure, transferred to capital. Whether it is net profit or net loss, it will be adjusted in capital. Net profit will be added to capital and net loss will be deducted from capital. That's it. This is the end of profit and loss account format. Now I am coming to the last format, that is format of the balance sheet. I told you balance sheet is not an account. It does not have debit and credit side. It's a statement which lists down all the capital liabilities on one side and assets on the other sides. If you do not commit any mistake, if there are no clerical errors, then the total of capital and liabilities will be equal to total of assets. Balance sheet will not be prepared for a period of time. Balance sheet will be prepared as on a particular date. That's why the heading should be written balance sheet of dash, name of the company, name of the businessman, divided by say as on dash, as on a particular date. Like accounts are closed on 31st March. So we'll take as on 31st March or 31st December, whatever it may be. So left hand side will take all liabilities, right hand side will take all assets. Now, while marshalling the items, marshalling means arranging the items. There are no hard and fast rules which items should be taken first, which items to be taken next. Normally, accountants and authors have distinguished, classified into two methods called according to liquidity, according to permanency. According to liquidity, liquid assets should come first. Liquid assets means those assets which can be converted into cash easily. Example, cash in hand, cash at bank, stock, debtors, bills receivable, all short-term investments, all these are the liquid assets that should be taken first. Then fixed assets. After completing liquid assets, we'll take fixed assets. Land and building, plant and machinery, furniture, fixture, etc. This method is called liquidity method. Liability side also will follow the same thing. Current liability will take first. Sundry, creditors, bills payable, outstanding expense, then bank overdraft. After that, we'll take long-term liabilities like loans. Then we'll take capital. This method, if you follow, it is called liquidity method. Another method, permanence method. Under permanence method, first we take fixed assets. First we take fixed assets. Goodwill, land and building, plant and machinery, furniture, fixtures, vehicle, etc. Then we take current assets. The current assets, stock, debtors, bills receivable, cash in hand, cash in bank. So, liability side also, first we take capital. Then we take long-term loans. Then we take current liability. Any one of the method you can follow, either liquidity method or permanence method. Here we have followed liquidity method. I have taken an example of liquidity method. So first of all, I am taking asset side, cash in hand, cash at bank, outstanding income. Outstanding income means income receivable. Then investment, bill receivable, sundry debtor, closing stock, prepaid expense, loose tools, advances given. Up to here you can see all these assets are current assets, easily convertible into cash within a short period of time. These are the current assets. Then from furniture, fixed assets. Furniture and fixture, patent and trademark, vehicle, leasehold property, land and building, plant and machinery, goodwill. In this format, we can take all the assets on the asset side, right? This is, again, I'm telling you, it's an example to make you understand the format I'm giving. Don't think every problem will have all these items, whatever I'm saying. This is only an illustration, example. Now, liability side. Sundry creditors, bills payable, outstanding expense, income received in advance, loan on mortgage. So, up to income received in advance, these are the current liabilities. These are the current liabilities. Sundry creditors, bills payable, outstanding expense, income received in advance. Current liability means those liabilities which are payable within a short period of time, like 1 year. Similarly, loan on mortgage, bank loan or overdraft, reserves. Then last one will take capital. In capital, how to adjust it? Now see carefully with full concentration, focus it. Capital will take the opening balance. Beginning of the year, how much was the capital given in the trial balance? That will take opening capital. To this we add net profit. Net profit, what we got in profit and loss account. Whatever net profit we got in profit and loss account, that will be added net profit. Add interest on capital. If in the problem it is saying that interest on capital has to be paid, then interest on capital will be added. Every problem we don't have interest on capital. Some problems it will specify in adjustment interest on capital has to be provided. In that case, interest on capital will be added. Similarly, drawings. Drawings means when the amount has been withdrawn from the business for personal use by the owner. When the owner withdraws money or goods from the business for personal use, it is called drawings. So drawings will be deducted from capital. Drawings will be deducted. Interest on drawings will also be deducted from the capital. So remember this rule. Take the opening capital, add net profit if there is net profit. If there is net loss, deduct net loss. Deduct net loss. Then we have interest on capital will be added. Drawings will be deducted. Interest on drawings will be deducted if there is any, not in every problem. Then we'll take the amount in outer column. Now, if you have not committed any mistake anywhere, then definitely the total of the liabilities and the assets will be equal. In other words, your balance sheet will tally. So here in this video, I have explained you the format of trading account, profit and loss account and balance sheet. Hope you have understood the complete format of final accounts. If you have understood, if you are satisfied with my lecture, give a like to the video, give your comment, share it in your group, subscribe my channel if you have not subscribed. We'll continue the next topic on this final account. Hello viewers, now I am continuing the theoretical part of final accounts of sole trading concern. Hope you have watched the first and second video regarding this provisions regarding how to make the final accounts of a sole trading concern. I am Hashim Ali Khan. So I am discussing the subject financial accounting. In this subject already I have prepared the videos for BRS bank reconciliation statement, and second topic I have taken up the final accounts of sole trading concern. So in the first video I explained you regarding the theory of what are final accounts, how to make the final accounts, what is the purpose of making the final accounts. Then I have explained you the format of trading account, profit and loss account and balance sheet. Now the last theoretical part of this video is regarding the provisions, regarding the adjustment. See here, when we prepare the profit and loss account, trading profit and loss account and balance sheet, we are given a trial balance and some adjustments. Trial balance are all the balances taken from the ledger accounts. But at the end of the year, when we make the final accounts, we have to make some adjustments. What are the adjustments? How to adjust it? Now in this video I am going to explain you. See here, we are preparing the trading profit and loss account for a period. When we prepare for a period for 1 year, we should take all expenses, losses, incomes and gains of that particular year. We should not take any of the item of income, expense, losses, incomes or gains of the earlier last year or next year. For example, if we are making the accounts for the year 2018, so we should take all incomes, expenses, losses of the current year 2018. If any income, losses, expense, loss of the previous year 2017 or the next year 2019 are given, we should adjust it. We should adjust it. So these are called the adjustment. Apart from that, we have to make the adjustment regarding non-cash items like depreciation, provision for doubtful debts, etc. So these are the adjustments we have to make at the time of making the final accounts. Now I'm going to explain you each and every adjustment. See carefully. If you understand this adjustment, definitely there won't be any problem while solving the problem. So first adjustment for final accounts. First one, closing stock. In almost every problem, you will find closing stock in adjustment. So the entry for closing stock is closing stock account debtor to trading account. Closing stock account debtor to trading account. This is the entry for recording closing stock. The value of stock which is remaining unsold at the end of the year, that is called closing stock. So what is the effect of this entry? Adjustment entry is closing stock account debtor to trading account. The closing stock should be taken on the asset side of the balance sheet. The closing stock should be taken on the asset side of the balance sheet. Again, closing stock should be taken on the credit side of trading account. Credit side of trading account. So what is the dual impact of this adjustment? The closing stock should be taken on credit side of trading account and the same closing stock should be taken on the asset side of the balance sheet. That's it. Sometimes adjusted purchases are given in the trial balance and closing stock is given in the trial balance. Closing stock is not given in the adjustment. In most of the problems, almost all the problems except a few problems, the closing stock will be given in adjustment. But some cases, very rare cases, you will find closing stock in the trial balance itself. When the closing stock is given in the trial balance, there won't be opening stock in the trial balance. There won't be opening stock in the trial balance. Why opening stock is not there? Opening stock and closing stock are adjusted in purchases. In that case, adjusted purchases will be given in the trial balance. Opening stock will not be given, closing stock is given. So how to treat in that one? Adjusted purchases will be taken. Adjusted purchases will be taken in the trading account debit side. Opening stock will not be taken, right? In closing stock, so if adjusted purchases are given in the trial balance, in that case opening stock will not be there in the trial balance. Closing stock is there in the trial balance, that closing stock only will be taken in balance sheet asset side. Don't take closing stock in trading account. Only adjusted purchases will be taken on the debit side of trading account. Closing stock appearing in the trial balance will be taken in the balance sheet. That's it. These are the cases in closing stock. Second is outstanding expenses. Outstanding expenses means the expenses which are due of the current year but not paid. Example, the total salary of the current year is 1,20,000, out of which only 1 lakh rupees salaries are paid. 20,000 salaries are of the current year but unpaid, not paid. The business has not paid salary. That is called outstanding salary. So what is the entry for outstanding salary? Salary account debtor to outstanding salary. Any expense, I am giving an example of salary. Outstanding salary, outstanding rent, outstanding interest, anything may happen. So expenses account debtor to outstanding expenses, or salary account debtor to outstanding salary, rent account debtor to outstanding rent. This you have to remember. Now what is the effect? What is the treatment now? The outstanding expenses are added to expenses in trading profit and loss account. outstanding expenses are added to expenses in trading profit and loss account. Again, these outstanding expenses will be taken on the liability side of the balance sheet. So add salaries to salaries in P&L account, and again outstanding salary will be shown on the liability side of the balance sheet. That is outstanding. Unexpired or prepaid expenses. Unexpired or prepaid expenses means expenses paid in advance for the next year. Current year itself it is paid. Example, our current year is 2018. Current year 2018. We have paid insurance premium, suppose 2000 rupees insurance premium we have paid. Current year we have paid insurance premium 2000 rupees. But it is given that out of 2000, 500 rupees insurance are paid in advance for the next year also. Next year is 2019. For 2019 also 500 rupees we have paid in 2018 itself. So this is called expenses paid in advance or prepaid expenses. Or prepaid expenses. So what is the entry for prepaid expense? Prepaid expenses account data to expenses account. Prepaid expenses account data to expenses account. Now I'll give the example, insurance paid in advance. So prepaid insurance account data to insurance account. Prepaid insurance account data to insurance. What is the effect of this entry? The prepaid insurance will be deducted from insurance on the debit side of P&L account. On the debit side of profit and loss account, we deduct prepaid insurance, and that prepaid insurance will show it on the asset side of the balance sheet. The prepaid insurance, 500 rupees prepaid insurance will be shown on the asset side of the balance sheet. Simply deduct prepaid insurance from insurance in P&L account, show the prepaid insurance on the asset side of the balance sheet. That's it. Next, outstanding or accrued income. Outstanding or accrued income means income receivable, income earned but not received. Income earned but not received, that is called accrued income. So entry for accrued income, accrued or outstanding income account data to income account. Accrued income or outstanding income account data to income account. What is the impact of this one? We add accrued income to income on the P&L account. Example I'll give you. Suppose interest accrued. So interest earned but not received. So this interest earned but not received will be added to interest in P&L account credit side. Profit and loss account credit side, we are given the income 10,000 rupees, accrued income 5,000 rupees, 10,000 income earned, received, and 5,000 accrued, दोनों को add करके 15,000 auto column. This accrued income, outstanding income will be shown on the asset side of the balance sheet. Income receivable है, asset है ये, so this will be shown on the asset side of the balance sheet. Next, income received in advance. That means income has received but not earned. We have received the income in advance. So the entry will be income account data to income received in advance. Income account data to income received in advance. What is the effect of this one? Deduct the income received in advance from income on the credit side of profit and loss account. The P&L account credit side we take income. Suppose interest income. So interest we take it in the inner column, less income received in advance, minus कर देंगे, and that income received in advance will be shown on the liability side of the balance sheet. So accrued income is an asset, income received in advance is a liability. Next one is depreciation. Depreciation is a decrease in the value of the asset due to wear and tear. When a machine is used, the value of the machine will decrease as we use it. So that is depreciation. So provision for depreciation, entry for depreciation is depreciation account data to asset account. Machinery is the asset. Suppose we have provided depreciation on machinery. So entry will be depreciation account data to machinery account. What is the impact? The depreciation will be shown on the debit side of P&L account. Profit and loss account debit side we take depreciation, and this depreciation will be deducted from the concerned asset on the asset side of the balance sheet. On the balance sheet, asset side, machinery, plant and machinery minus depreciation. Minus depreciation. This is the depreciation. Next is interest on capital. In some of the problems, in adjustment it will be given provide interest on capital at 5%. This is the adjustment given. So how to make that? What is the entry for this? Interest on capital account data to capital account. What is the impact of this one? Interest on capital will be taken on debit side of profit and loss account. Debit side of profit and loss account. And this interest on capital will be added to capital on the liability side of the balance sheet. Balance sheet liability side will take capital. To capital we add interest on capital. So one effect, profit and loss account debit side. Another effect, add this interest on capital to capital on the liability side. Next, interest on drawings. When the business is allowing interest on capital, the business may charge interest on drawings. When the owner has withdrawn the money from the business for personal use, it is called drawings. On that drawings, the business will charge interest. So interest on drawing is an income to the business. Interest on capital is an expenditure to the business. So entry will be capital account data to interest on drawings. Capital account data to interest on drawings. Now how to make the adjustment? The interest on drawings will be taken on the credit side of profit and loss account. On the credit side of profit and loss account. Again, this interest on drawing will be deducted from capital on the liability side of the balance sheet. That's it. Next comes bad debts. Bad debts means the debts which are irrecoverable. When we sell the goods to customers on credit, there is no guarantee that in future the customer will honestly pay the full amount. There may be chances that some of the customer may not pay the amount. So that is called bad debts, irrecoverable debts. It's a loss to the business. So entry for bad debts is bad debts account data to debtors. Debtors or account receivable, whatever you call. So bad debts account data to debtors. What is the impact? How it should be treated? Bad debts will be taken on debit side of profit and loss account. Bad debts will be taken on debit side of profit and loss account. And these bad debts will be deducted from debtors on the asset side of the balance sheet. Provision for bad debts. There is difference between bad debts and provision for bad debts. When the debts are completely irrecoverable, completely bad, it will be called bad debts. That means we are completely 100% sure we cannot be able to recover the amount. That is a dead loss. That is a bad debts. But sometimes a provision for doubtful debts has to be made. That means the debts may be recovered or may not be recovered, because according to convention of conservatism, we have to play safe. Provide for all expected losses, but don't provide for expected gain. Provide for all expected losses. So there may be loss. Bad debts are not there, but we expect that some debtors may not pay. We are not sure, but this is an expected loss. Bad debts are the actual loss. Provision for bad debts are the expected loss of bad debts. The entry will be profit and loss account data to provision for doubtful debts or bad debts. So entry, what is the impact effect? On profit and loss account debit side, we take provision for bad debts. And again, this provision for bad debts will be deducted from debtors. So on the asset side, we have to deduct bad debts. We have to deduct provision for doubtful debts if it is given in the adjustment. Provision for discount on debtors. Sometimes the debtors may pay the amount promptly before the due date and may claim discount. For example, we have allowed some 3 months credit period to my customer. 3 months credit period. So already I have given 3 months. That means I have sold the goods and told him that you can pay me after 3 months. But within 1 month, he may come and ask that I will pay the amount right now, give me the discount. So I have to provide the discount because I have given him 3 months period. He is paying in 1 month. So I have to pay discount. So this is called provision for discount on debtors. It is a loss to the business. So we will debit provision for discount reserve for discount on debtors, provision for discount on debtors. So profit and loss account debit side, provision for discount on debtors credit side. It's a loss to the business. So profit and loss account will be debited. This is the entry. What is the impact? This provision for discount on debtors will be debited to P&L account, and this will be deducted from debtors on the asset side of the balance sheet. Now, reserve for discount on creditors. Just like we are allowing discount to debtors, we may get the discount from the suppliers. From the suppliers, we will pay the amount promptly. Suppose my supplier has given me 3 months time period to make the payment, but I am making the payment within 1 month and I am claiming the discount from my supplier. This is called discount, provision for discount from the creditors. So it's a gain to me. So entry will be reserve for discount on creditors account debtor to profit and loss account. So profit and loss account credit side by reserve for discount on creditors. And this reserve for discount on creditors will be deducted from creditors on the liability side. Then loss of stock. Sometimes in some problems it will be given loss of stock by fire. So loss of stock by fire. Some goods are destroyed by fire. So entry for stock lost by fire is loss by fire account debtor to trading account. Loss by fire account debtor to trading account. So trading account के credit side पर by loss of fire we are going to take. Now there are two cases. The loss may be insured or the loss may not be insured. Normally what will happen, a businessman will take an insurance policy, loss of stock insurance policy. In that case, the insurance company may pay the claim for that loss of stock. So what is the entry? If goods are insured and full claim is admitted by the insurance company. Suppose my business have incurred a loss of rupees 10,000, loss of stock 10,000. I have claimed from the insurance company. Insurance company has agreed to pay full amount of 10,000. There is no loss to me. So in that case, if the full amount is admitted by the insurance company, entry will be insurance company account debtor to loss by fire. So first entry, loss by fire account debtor to trading account. Second entry, insurance company account debtor to loss by fire. What is the impact? This insurance company account amount due from insurance company will be shown on the asset side of the balance sheet. And this loss by fire is credited. It will get closed. First we have debited here. Now we have credited. So loss of fire account will get closed. The amount due from insurance company will be taken on the asset side of the balance sheet. Suppose goods are insured and insurance company admits a part of the claim. The insurance company has not agreed full payment. The insurance company has agreed only part payment. 10,000 rupees worth of stock was destroyed, out of which insurance company agreed to pay 8,000 only. Remaining 2,000 is the loss, net loss. So in that case, the entry will be insurance company account debtor 8,000, profit and loss account debtor 2,000 to loss by fire 10,000. The profit and loss account will be debited loss by fire 2,000 rupees. This is the case when insurance company has admitted partly, not fully. Then goods distributed as free samples. Sometimes a business will distribute free goods to the customers as advertisement. In that case, the entry will be advertisement account debtor to purchases account. What is the impact? In P&L account, we take debit side to advertisement. In trading account, we deduct that advertisement from purchases. From purchase. So deduct from purchases and debit on P&L account advertisement expense. Last one, goods withdrawn for personal use. Sometimes the owner of the business will withdraw the goods for his personal use. It is called drawings. So entry will be drawings account debtor to purchases account. So what is the effect? Drawings will be deducted from capital on the liability side of the balance sheet, and that amount will be deducted from purchases in the trading account. So these are the 15 normal adjustments to be made while making the final accounts. So we have completed the theoretical part of final accounts of sole trading concern. So if you have watched fully from beginning till end, definitely you don't find any problem while solving the problem of final accounts. The whole problems depend on this theory, so don't underestimate this theory video. So watch till the end. get a good grasp on this subject, and then we'll start in the next video the problems on final accounts of sole trading concern. If you are satisfied with my lecture, give a like to the video, share it, subscribe it, and give your precious comments regarding these videos. I'll continue the problems in the next video.